So we start with first part, our part A. B and C are theoretical, and in A part we have we have three things to calculate. One was no hedge. No hedge actually we don't need to calculate at all. The second one was options, and the third one was swaps. So these are the three things we need to calculate. Hedge actually, no hedge we don't need to calculate. We will just see that interest rate can go up 0.5%, can go down 0.5%, and it will remain. We take the risk on ourselves. Options and swaps. So if I start with options, the first thing is that what you are going to do. You have risk of increasing interest rate, right? Increasing interest rate. Because if interest rate goes down, because you are borrowing, so in case of borrowing, interest rate going down is not a risk. Interest rate going up is a risk. So we have to do put options. This is what we are going to do. We are going to get the put options. So that if interest rate goes up, we will sell. Put options means that you have a right to sell. So if whatever you have options which you have purchased, as the interest rate will go up, your derivatives, your options price or value will also go up in the market, and you will sell it and you will make some benefit out of that. So this is the first thing to determine. And as before, our loan size is 18 million. Did I write down the correct number of zeros? Yeah, $18 million loan size. This is the borrowing which you need to do. And contract size is, how much is 1 million? Contract size is 1 million. And loan, how much is the duration? So you need to borrow, you have a borrowing of, it says that, I'm just trying to calculate for a period of 7 months. So we need to calculate the number of contracts which we need. And duration is 7 months. So we can say that number of contracts. You see, the red line comes here. This is what I made before. Okay, I'll just make format painter from here. Okay, number of contracts, how many do we need? So I can just simply, you know, and actually year, months in a year. I'm just putting these numbers here so that I can use the formula. 18 million divided by 1 million. If I do like this, it means 18 contracts, but I don't need 18 contracts actually, because each contract has 3 months duration. So what I further need to do, I need to multiply it with, you know, this number 7. This is the total duration of the loan, and divided by 3, because we know that the standard contract period is 3 months. And actually I should say contract period, and I put it 3. So I can just, instead of putting 3, I'll just use it here. So I need 42 contracts. The first thing which you always establish is that what are you going to do? You're going to get put options so that you can pick up numbers from here, okay? And the second thing you do, that you need to find out your number of contracts. Standard thing, the standard format we did it before, it is 42 basis point. So far, any question you want to ask?
Where did you get that contract period of this?
Okay, this is standard. You know, it will always be 3 months in all the questions, because these options are always 3 months.
Okay.
So you can take it as a fixed number whenever you will do. Okay.
Okay, sir. Okay.
So what is next? You have a strike price, which is 95.50. And if I say 100 minus 95.50, it gives me, just now putting the numbers, it is 4.5% actually. What is, you have the strike price 4.50 in March. And then you have your When you will go to February, so your current price would be, now this is 4.5, and let me put it, okay, 4.5%. Now, what we need to do, we need to calculate how to do it. If you remember, we said that we know our strike price, but we need to calculate expected price of options on 1st of February. This is the date when you want to take loan. If you remember, I said in the discussion part previously, we said that we will see that this 4.5 should we exercise or should we lapse, and we need to compare it. And compare it with what? Compare it with the market price. And how do you calculate the market price? We say expected price of options on 1st of February, how much it will be. So if we say that, because we said that there is a possibility that increase in LIBOR can happen or a decrease in LIBOR can happen. Both things can happen, increase in LIBOR or decrease in LIBOR. And let me first find out for increase in LIBOR. If the LIBOR increases, this market price of this future, it would be 100 minus your current LIBOR is 3.8%, if I'm not wrong. Current LIBOR is 3.8%. So it means that it would be 100 minus 3.8. And I'm putting it as, minus 0.5, which means that 3.8 and 0.5 I'm adding. Or let me write it down like this. 3.8 plus 0.5 is equal to 4.3, okay? So this is what you see, that LIBOR will go up. So you can say that 100 minus 4.3. So if you say 100 minus 4.3, but then there are some unexpired bases also. So let me not talk about bases here. Let me not talk about bases, and I'll put the number here. It means that the future price in market, this contract in the market would be 95.7, and then you can say that 100 minus 95.7. So interest rate would be 4.3, 95.7 will be the price. You, by the way, have a price of 95.50. 95.50 is your strike price, which is available. And you think that in February, if the LIBOR goes up, what would be the price? I calculated 95.7, but this is wrong, because you also need to understand that there is a time value of money, because this is March. This is a March option. See here, the March option, 44, it is starting from here, end of 1st of January, 1st of February, 1st of March, and end of March. Here it will become 0. Here your future and spot and market price and the contract price will become equal. It becomes 0. Time value of money becomes 0. But when you are on 1st of February, there are still some bases, and those bases will be the difference between the market price and that. And these bases are 22. So we need to take account of these 22 bases. We did this in previous question as well. We subtract here your 0.22, the 22 basis point. And now when you put 22 basis point, the answer is 95.48. Now what it gives you, the two numbers. Now please, I'm not in a hurry to move forward. Understand what is the thing. The futures, this future, under these conditions, its market price would be on 1st of February 95.48, whereas you have a strike price of 95.5, which mean, and you have put options, which mean you can sell. So there is something, forget about whatever it is, there is something which in the market is price is 95.48 and you can sell it for 95.5. So naturally speaking, there is a gain. We can see that there is a gain. And how much is the gain? The gain is 95.5 minus 95.48, 0.02, which means that 2 basis point there is a gain. Please understand, there is a gain of 2 basis point if the interest rate goes up. If LIBOR increases, so then what will happen? If LIBOR increases, the market price, and this is what this is confirm. This is what we predict and what we forecast. Okay, this is what we predict. We predict that currently market price is 3.8. Libor will go up by 0.5. Libor will become 4.3. And plus this future will also have some how to say basis into that, and that basis is time value, because it is not the contract has not yet expired on 1st of February. So those bases you must also subtract. So you calculate the final price, and this is your predicted price, and this is your expected gain. Now it is possible, like we discussed in previous lesson as well, that maybe the interest rate does not go up by this, then this will not hold true. Or maybe there are not 22 bases. We are just assuming that bases will remain there. Because we are, if you see 44, 33, 22, 11, we are assuming that. So we assume that these 44 bases, they will evenly decrease over the period. It has 4 months, December, January, February, March. So from 44, 44 divided by 4 is 11. So every 1 month, it will lose 11 basis point. So this is the time value of listen, this option, it has some value. And within that value, there are two things, intrinsic value and the time value. Because of the time value, this is 44 basis. The 44 basis is the value of which is embedded within the option because of the 4 months time period. And with every month passing, this value is going to go down. And when the time will finish, it becomes 0. So we assume that on the second month, like on 1st of February, like December has gone, January has gone, and on 1st of February, 22 bases will be available there. Now, in reality, it might drop much faster, or it might drop little later like this. I don't know. What will happen in reality, we don't know. But we predict. So this is our assumption number 2. So based on these two assumptions, like the Libor has gone up by 0.5, like 0.5%, and there are still 22 bases available. Let's suppose this is the price, and you make a gain. So that is clearly you have a gain here. So you can execute the contract, and then you should calculate how much gain we are making. So we have total gain. So we are exercising the option on exercise, total gain on exercise. The options. Now, if you remember in previous question, how did we do that? How to calculate these basis point? What we did previously, if you remember the data from the question which we did in last lesson, we said that you have tick points, ticks multiplied by value of ticks multiplied by number of contracts. Okay, this is the way you calculate. You said that I made some gain, I should exercise this contract, and if I exercise the contract, how should I calculate how much benefit I get? I understand that each contract is giving me 2 basis point benefit. It is beneficial for me, so I should exercise it and I will get benefit. But how to calculate it? This is the method we use in previous question. The number of ticks, now tick and basis is same. For example, there are 2 basis point, and you know that within 1% there are 100 basis point. 100 basis point are within 1%. So when I say 2 basis point are there, which means that 2 ticks are there. And then in previous questions, they gave you that 1 tick value was $25, if you remember. Let's suppose that if they tell us again that 1 tick value is $25, let's suppose. So then I should say 2 ticks multiplied by $25 multiplied by my number of contracts, and number of contracts are 42. And this is how I could have or would have calculated the value of the gain. But unfortunately, in this question, they have not given you the value of the tick. So you cannot use this formula now. What we can do very easily, we can see that how much is the borrowing? The borrowing is for 18 million. And what percentage I am earning? I mean, if I say that 18 million and there is a certain percentage, let's suppose I am earning 1%. If my gain is 1%, I would multiply it with 1%, right? But gain is not 1%. Gain is how much? Gain is 2 ticks. But 2 ticks means what? Is it percentage? No. So 2 divided by 100. If I multiply, if I write down 2 divided by 100, it makes like 2 out of 100. Remember here. And actually I should do again by 100. And then I should multiply it with 3 and then divide it with 12. Now let me explain this. Why do I say 2 divided by 100 divided by 100? Because otherwise you will get confused in exam. See here. 1% has 100 ticks, okay? 1% has 100 ticks. 2 ticks means 2 out of 100. So 2 ticks means 2 out of 100, which means that 2 divided by 100. And then convert percentage into numbers, because we want to calculate dollars, because we don't want to calculate how to say percentages. We want to calculate dollars in order to calculate USDs. So then what I do, this 2 divided by 100, I further divide by 100. So any percentage converted to number, you have to divide it with 100. And that's why I said $18 million. And this is the amount which I am investing or which I am hedging. This is the gain, 2 divided by 100 by 100. And by the way, and this is the period, 3 months divided by 12 months. Am I clear on that? Do we have it? Yeah, 18 million we have. Yeah. So let me calculate it here, and I put it 0 is equal to. Sorry, this is actually 7 months. Not our loan is for 7 months. Contract is 3 months, but we made 7-month borrowing. So it gives you 2100. Now this thing I'm going to just delete it, or I can put it here, but I can just make it italic. This is not for part. This is not, you will not going to write down in exam. This is our own understanding, okay? So I just make it gray so that you see it here. Are we clear on that?
Yes, sir.
Gain on exercise. So my gain on exercise is 2100. But then what I need to do, I need to make a borrowing. How much is my borrowing, by the way? Because we want to take now borrow funds, I would say borrow funds at LIBOR plus 0.3%. See here, I said that fixed rate we will not borrow at all, because fixed rate was very high. If you remember in the beginning, I said that I've actually deleted that. But in the beginning, I said that fixed rate is 5.5%, which never makes sense. I would say 3.8% plus 40 basis point, and plus if it goes up with 0.5. So it means that what rate I am borrowing. If I'm borrowing at, if in 3 months time, interest rate goes up, we say that expected price of, we said that increase in the LIBOR. So let me write down here, increase in interest rates by 0.5%. This is my heading, okay? This is what is happening. If there is an increase in interest rate, what will happen? My expected price after increase by 0.5%, expected price of the option will be 95.48. which means we will make a gain of 0.2 if I subtract these two numbers. And that gain, when I converted it into USD, it is 2100, 2100. And then what I'm going to do, I will borrow the funds. I don't know, why do I need these numbers? So borrow funds. And what price are you going to borrow? You are going to borrow funds at 3.8 plus 0.5 plus 0.3. 3 basis points you have. Your borrowing capacity is 3 basis point, which means that you will borrow the money at 4.6. This is your borrowing rate, which will be 4.6%. 3.8, no, we have 40 basis point, I'm sorry. 30 basis point was swap, the other party. We can borrow at 40 basis point. So how much we will borrow? We will borrow 18 million. Yeah, I'm just getting stuck with this thing. So 18 million multiplied by 4.7. This is percentage divided by 100, multiplied by my borrowing period is 7 months divided by 12. So my cost of borrowing will be 493,500. And this is my gain. So this is my cost. This is my gain. So what should I do? Add or subtract? Add or subtract? Subtract. But there is one more thing. Option premium, right? So option premium will be how much? You have to pay the option premium also. What was your option premium? 18 million multiplied by 7 divided by 12, or you can do it by the with number of contracts also, with the 0.622. 0.662. This is in terms of percentage, because it says that in annual percentages. So I can put it like this. I can say it like 18 million into 7 by 12, the duration multiplied by 0.662 divided by 100. Let me see it here. What do I get the number? I get 69,510. This is my option premium. This is my also cost. So then what we do, that this is my A, this is B, and this is C. And then I have to calculate my net impact. And the net impact will be B plus C minus A. Does that make sense? B plus C minus A. This is my interest rate.
Yes.
Plus
Yes, sir.
this is the premium we will pay, minus this is the gain which we will make. So it gives us 56,910, 560,910. This is going to be your net interest, or not net impact, net cost of borrowing. Now you see that this option has secured you, but you paid some option premium for that to protect your position. By the way, if you had not gone for hedging, like in this particular case, it looks like that no hedge is a very good idea. No hedge is a very good idea. But in any case, we'll see. But when you do hedge, you have to pay this 69,000 extra. What is this 69,000? These are the three numbers. This 69,000, I just pay the fee for protecting myself. This is my option fee. If I had not gone for hedging and I said, you know what, I'm not doing hedging, so I would not make this gain. I would also not make this. If you see, gain is very little, option cost is huge. I would just pay like 0.5%. It goes up. I'll go to the bank and I'll pay 493. I mean, if I don't do hedging, I would be paying 493,500. But there will be always a risk that if it goes up, then what happens? So therefore, we decided to hedge. But as a result of doing hedging, our net borrowing cost has gone to 560,910, which is very significant. Now, if we go back to the same thing, now let me copy paste this thing. No need to copy paste. Let's suppose that we say not increase, but decrease. Decrease in interest rate by 0.5, because they said that interest rate can move in both direction. So if that happens, then your your new LIBOR would be how much? It would be 3.8 minus 0.5. Okay, LIBOR would become 3.8 minus 0.5. So then what will happen? You still have and this thing actually will remain same. We don't need to do that. 3.8, 0.5. My new LIBOR will become 3.8 minus 0.5, which is 3.3. And here I would write down 100 minus 3.3 minus 0.22. Only these numbers I changed, if you pay attention. From 4.3, I made 3.3. Okay, because one time it was going up, now I say it goes down. So it means that what this number gives me. Now, see here. I would say that my exercise price will not change, because exercise price was in the contract, that was 95.5. So exercise price remains 95.5, but my market price of option would be 96.48. So what should I do? Do you think that somebody will buy from me that thing? Should I exercise this thing now? Should I exercise? Before it was higher, so I exercised. Now, if I make here like this minus this, I'm not making a gain, I'm actually making a loss. So I call it loss on exercise. Therefore, we will not exercise the options in case of decrease in interest rates. Are we clear on that?
Yes, sir.
It is like opposite, because if interest rate goes up, it becomes favorable. You are making a gain, two basis point gain, you exercised and you made a gain. Now you are not simply making a gain. So again, these three things I had, A, B, and C. Let me put them down here. I put them down here. So now I have loss. So if I have a loss, of course, I am not going to exercise. So I just make it 0. I'm not exercising. So why would I suffer the loss? I say, okay, just move on. What would happen? My borrowing will become, how much will be my borrowing? Should I change this 3.8 plus 0.5 or whatever? How do you calculate this thing? 4.7. So if interest rate goes down, so this would not be 4.7. How much it would be? So it would be like this, minus 0.5. Okay, so here I put like this. Your interest cost will be 388,000 because you are borrowing 18 million at 3.7% because interest rates have gone down. So your borrowing cost, your interest cost is 388. Your option premium will remain same. Option premium will not change because option you purchased at the beginning doesn't matter. Market interest rate go up or go down. And then I say net cost of borrowing is this. So I just simply add these two numbers. 458,010. Are we clear on the on this part as well? I mean, decrease in interest rates. If you do not understand, please ask me. Anybody wants to ask? Nobody wants to ask anything. Is it clear?
For borrow funds at LIBOR, isn't it LIBOR plus 0.4%?
No, we had Libor plus 40 basis point 0.4, but we said that interest rate decrease. So standing, I mean, in the beginning, interest rate was 3.8. I just decrease interest rate. So 3.8 minus 0.5 plus 0.4. Before we increased, before here, we said increase the interest rate because two scenarios. Here I'm talking about increasing in interest rate. And at the bottom, I'm talking about decreasing in interest rate.
Yes, that one is fine, but where you wrote borrow funds at LIBOR plus 0.3%.
No, Libor plus 0.3 is not given to us. Libor plus 0.3 is given in the swap option. Because Libor plus 0.3 basis, it is not our thing. It is counterparty or rate, some other party. When we will do swap, then we will use this Libor 30%. For us as Kishi company, our rate is Libor plus 40 basis point.
Okay, sir.
So this is 458,010. Now, if you want to calculate, so I say that increase interest rates, my interest cost is interest cost, and I would say interest rate. Okay. And then I say decrease interest cost with options. Okay. If I have options in my hand, and in the market, the interest rate may go up, interest rate may go down. If interest rate increases, my total interest cost is 560. If interest rate decreases, my cost is 458. And how do you calculate it in terms of percentages? When you want to convert it into percentage, now this is the interest, 560,000, you are going to your total interest cost, which includes the bank. Now, what it includes? It includes the payment to the bank. It includes the premium, which I paid for option, and it has minus the gain. This 458 includes the interest to the bank at a lower rate, plus the option premium 69. And of course, there is no gain or loss. And this is my total cost, interest cost, which is a composite of everything. It is for how many months period? Can you tell me? It is for how many months?
7.
7 months. Fine. Can I convert it into annual percentage? How can I convert it into annual percentage? If it is for 7 months, so how much it is for per year in terms of percentage?
Divided by 7, multiply 12.
Great. This is what I need to do. I will take this number, and this is for 7 months. I divide it with 7 and I multiply it with 12. So what you get, 961 divided with 7 multiplied by 12. Are you doing it correct, Eliza?
If it is for 7 months.
Sorry. This number over a borrowing of 18 million.
18 million, yes.
So this is, if you calculate like this, for example, it gives 3%, but it is not 3% because it is not for a period of this one. This is, you have to convert it into annual. So you will say that, divide it with 7 because this is for 7 months multiplied by 12. So it is 5.34%. And then I take this one. So it is 4.34%. If I have options in my hand, if I already had purchased the options, and if the market interest rate goes down, I am effectively paying 4.36%. If I have interest rate going up, I'm paying 5.34%. This is your one part, which is option. Second is swap, and I'm not going to take a lot of time on that. In swap, what do we have? In swap, we always have two companies. We have got a company called Kishi company, and we have the counterparty. Okay, counterparty means the other one. And there is a fixed rate and there is a variable rate. And after doing so much, we already remember that fixed rate was, I think, 5.5%. I do remember, but I need to confirm. I'm sorry, 5.5%. And their variable rate was LIBOR plus 0.4%, okay? Which means 40 basis points. Counterparty, the other party, they have got an offer of 4.6% and LIBOR plus 30 basis. So it is 4.6% and this is LIBOR plus 0.3%, okay? Now, definitely we can see that first thing, whenever you see the swap thing, you always first make sure that is there any benefit of doing swap or not. So of course, the difference between these two numbers, like this one and this one, it is 90%, which means, 0.9, actually it's not 0.9%. Let me remove the percentage. It is 0.9 like this, not in percentages. It should be like this, 0.9. It is like less than 1%. And what you get here, now if this company takes this one, the other company has to take this one. I mean, counterparty cannot take both of them. One loan must be taken by the counterparty, one loan must be taken by the Keshi company. And you should see that whichever is the better one. So counterparty has a very good rate for fixed. So counterparty will go and make 4.60 loan, and then Keshi company must take a variable rate because they also cannot take fixed now. They will take this fixed rate, but this fixed rate is 10 basis point more than this. So it means that if you are making a gain of 0.9, some part of that gain is sacrificed, is compromised, because 10 basis point they will be taking more. So it means that the net gain on swap arrangement would be, I call it total swap gain is 0.8. Share to Keshi company. I remember in question it said that 70% Keshi company can take. So 70% of this gain benefit will go to Keshi company, but Keshi company will also pay 10 basis point as their service fee or whatever you may call it. So what we say that out of the 0.8, 70% they will receive Keshi company. We are only calculating for Keshi, we are not calculating for other. Is 0.56, and the service fee is 10 basis point. We subtract it, and what we get here, what is this? This plus this. Minus 0.1.
The basis point, yes, okay.
So this is net gain from swap to Keshi company. 0.46. This is their net gain. 0.46. Okay, so now this 0.46, we can actually, now if we take uh, 0.46, they have so if we see that their fixed rate was 5.5, let me read the question here. Let's read the question. Where is that? Wait a minute. Rozu Bank has offered Keshi company a swap on a counterparty variable rate of LIBOR plus 30 basis point or a fixed 4.6, where Keshi company receive of any benefit from entering the swap prior to any bank. Rozu Bank will charge Keshi company 10 basis point for the swap. Okay, and let me go back above. Borrowing, it can the Keshi company expect to borrow on 1st February for 7 months. It can borrow the funds at a variable rate or a fixed rate. Keshi company feels that this could increase or decrease over the coming months due to increasing is considering whether or not to hedge using their exchange rate marshal country swaps offered by Rosu company. Okay. So if they go for, if they have this option for fixed rate, how much is their fixed rate? So their fixed interest rate is 5.5, and they will get benefit from swap, which is minus 0.46. I'm putting a minus sign because this is cost, this is gain, this is cost, this is gain. So that's why I put the minus sign, and their net cost will be 5.04%. So we say that after taking a fixed rate loan and having a swap, it will cost them 5.04%. Okay, that's all. So swap is also done. So swap shouldn't have been difficult. Now you can, numbers are there. You can make a conclusion that if there is a, now we know that variable rates are always less there. And by the way, fixed rate they should not take. It will take them 5.04%. And so fixed rate was much higher. So now you need to make a conclusion that in case the interest rate, they go up by 0.54%, the net cost is 560,000, which means 5.34% with option. If they make a decrease in interest rate, it will be 4.36%. This is with options. I draw the line. And the other option is that if they make a swap, the fixed rate will cost them 5.04. And if they go and take the variable rate, for example, and if the rate goes up or rate goes down, so it makes them 5.04%. For swap, it is 5.04%. So the better option is, your suggestion is that avoid fixed rate and go for variable rate plus swap. Take a variable rate loan and take a swap. If they take a variable rate loan, let's suppose variable rate loan, okay? So variable rate loan, if they take, it is possible that there will be increase or there will be decrease, right? If if it is fixed rate loan, it is 5.5%, no doubt about that. If it is a variable rate loan, then it can go up or go down, like 3.8 plus 0.5 plus 0.4, or it can be, 3.8 minus 0.5 plus 0.4. Do you understand what I'm doing?
Yes.
So if they take a variable rate loan, this is here, 4.7 or 3.7. So, variable rate loan, if they take, it could be 4.7, it could be 3.7. So you just don't hedge. So there is no hedging. If I don't do any hedging and I just simply go, just like I said that there are three options. I don't do any hedging. I just go and say, I'm taking a variable rate loan because fixed rate is too high, 5.5. So current rate is 4.2. Current rate is 4.2. It can go 0.5 up. It can go 0.5 down. In any case, it is 4.7% or 3.7%. This is my no hedging. If I go and do swap, it will cost me 5.04%. If I take option, it could be 5.3% or it could be 5.36%, 5.34 or 5.36, 4.36. Increase or decrease. But swap I must do, because in case of swap, it is fixing my rate here at 5.04%. So doing nothing, actually, it is very attractive because if you see that these percentages are lower, but you are exposed to risk. Although these cost, the cost looks less, you might be thinking that, if I am doing no hedge, I'm better off. So let's do no hedge. No, it's not proper, because if you do not do any hedge, you are doing a gamble, because you suppose that it will go up only by 0.5. What if it goes more? then what you will do? You will be stuck. And then the board will ask you, did you take any measures? And you said, you know what, I was very confident, or I was very positive, and therefore based on my confidence and based on my I don't know, optimism, I did not take any measures. You will be punished. We cannot leave it unhedged. It looks interesting, but definitely I will go and do hedging. And when I do hedging, I've got two options. I can go for options, or I can go for swap. If I go for swap, that is a better thing because it is fixed. In case of option, still there is some risk. It can go like this, it can come like this. But with a swap, I'm fixing it at 5.04. So I would rather go for a swap. So three options are there: no hedging, option, and swap. And options are not really very interesting here. Why this 5.34 is too high? Because if you pay attention, that even if interest rate moves in your favor, and it moves in your favor and you make a gain, that gain is nothing as compared to the option premium which you are paying. Your option premium is huge. So even if you make a gain, which is like 0.5%, it goes up or something, you will make a gain. But that gain is insignificant, and therefore the percentage has gone up so much. So option, in this particular scenario, I've got three things: no hedge, options, and swap. No hedge means gamble. I'm not for that. Option premium is too much, and it can end up me paying 5.34%, which I don't want. Swap, it makes sense. It puts me somewhere in between 5.04%, and I would go for the swap option. Are we clear on that?